Hello, everyone. My name is Ryan. We're going to talk about the best way to save for retirement when you're a small business owner. So, we're starting our financial planning series, and we're going to talk about all of the different ways that potentially small business owners can save for their retirement. We had a really interesting financial plan that gets into the nitty gritty of what happens when you need to start saving and you're a little bit later on in life, but you've had a very successful small business startup and you've been running it successfully for many years. This is the thing that we do. We love diving into financial plans, getting into the nitty gritty. All personally identifying information has been taken out of this plan. And so you'll get a sense of how deep we dive and how much you can learn from doing small business owner savings plans in retirement and the types of things that this particular small business had to interact with. And everything varies a little bit. Everything's different. It depends. Every financial plan is different. And you can see some of the expertise that we bring to bear. So this is what we're going to cover today. We're going to talk about the client's business tax return. They had some losses and then some gains. And then also we're going to talk about income statements, assets, some goals that they have, and then some recommendations that we had for these clients. This is our disclaimer that says we're doing the best we can. Things change, and it's based off of assumptions, and those assumptions are not set in stone. So this particular client during COVID had some business losses. They also then had some profits in 2022. And then moving forward, they've been quite profitable. And they're actually organized as an S corporation. And they were particularly in a bit of a pinch because they took out more money than they could during their losses time. And so they were taxed on the money that they took out. It's almost as though you look at the bottom and you see that they sort of almost got a loan from the business and they had to pay taxes on the money they took out for living expenses. But they did, unfortunately, when they earned back profits to sort of earn back those losses, they were taxed on those profits, even if they're not seeing the profits as K1 distributions. And so we had to look at what their income was going to be over different years and craft a financial plan to start the savings process. So this particular business had W-2 income to the business owners, and then there were also K1 distributions. However, those K1 distributions only while they're going to be taxed in 2023 at probably projected about $55,000, they're actually only going to receive 25,000 as income. And the reason why is they have to earn back some of those losses. They also are going to expect a QBI deduction, that's qualified business income deduction, and then there's some taxes. So we came to their net monthly income of what they can expect at $9,000, $9,208. But moving forward into 2024, they will pay off their business debts, quote unquote. And then from there, they're going to be able to take much more distributions and their current monthly income will jump up to about 11,000. Currently, they actually have nothing saved for retirement, but they have a lot of home equity, and they also have a really strong business valuation as well at roughly $370,000. It is important that when we do have business valuation, this varies wildly based off of the type of business, what type of income is generated, and projections for growth and where the business is located. So this is an estimate that is utilized. However, it could be different based off of later on in their lives. So these are their particular estimates. Their mortgage makes up a good amount of their expenses, but you can see their expenses are totaling about $5,800 a month. But there are many other factors in there, and we broke it down. Everything else is very reasonable for living where they're living. When we get into retirement planning, these are the factors that we do end up talking about quite a bit. Quickly summarizing them: how long you live, expenses, inflation, income, how they take withdrawals, how their money is allocated in their investment accounts, and then other goals and things that change. So what we had to do in this financial plan is we had to analyze what are the best ways to save for retirement. So there are traditional IRAs and Roth IRAs. If you're not familiar, traditional IRAs are where you save on taxes now, but you pay taxes later. And in Roth IRAs, you pay taxes now, but you don't pay taxes later when the money is pulled out. With traditional and with Roth, both of them you can open up on your own. It doesn't need to be affiliated with a business. And it's a great place to start. There are no startup costs, very easy. Many financial institutions do them. SEP IRAs, on the other hand, are a little bit different. You actually open them up through a business. And one of the big things with SEP IRAs is that when you contribute on behalf of the owners, you also have to contribute on behalf of the employees, and it's based off of the percentage. So you'll see that if you contribute 8% of an owner's salary, that's W-2 income. You also have to do the same thing for all of the employees. Now, the employees, they need to be there for 3 of the past 5 years, and there are some other nuances to that. But you can see that whenever you open up a SEP IRA, well, it's very inexpensive to open up. If you have a lot of employees that have been there for a while, it can be very expensive from a funding standpoint for the business. This isn't necessarily a disadvantage because it's great that you're funding employees' retirement, but from a cash flow perspective, it does mean that you'd probably have to offer your employees a little bit less in salary in order to fund their retirement accounts if you're used to not funding retirement accounts for employees. And this is common for small businesses that might have 1 or 2 employees. It's a significant expense to help save for employees' retirement. And so you might have to reduce some of the salary in order to make the contributions to employee retirement accounts in order to make the cash flow more acceptable. Now, later on, when a business gets more established, and especially for small businesses, there are 401k plans, which are very common. Usually there's a setup fee and then an ongoing administrative fee. If you don't have employees, you can open up an individual 401k. And in this case, these clients, they would probably benefit most from what's called a safe harbor 401k. 401ks usually are subject to testing requirements because they don't want the owners saving significantly more than their employees. And so one way to bypass a lot of those testing requirements is to do what's called a safe harbor 401k, where all employees get 3% of their salary automatically put into their 401k account, and you don't have to go through all those testing requirements. Lastly, there's a cash balance pension plan. This is when you have owners of typically small businesses that are older, make high salaries, and have younger employees. Cash balance pension plans are really great when you have high incomes as well for those employees, because you can save a lot of money pre-tax into retirement accounts and save a lot of money on taxes when you're in those very high income earning years. So we looked at all of this for this small business. Now, we also ran a retirement snapshot. We ran 2. Sometimes we run 1, sometimes we run more. All person identifying information has been removed from this. That's why you see the start date, end date taken off. But this is the type of analysis that we do for clients. What we do is we say, okay, based off of your current expenses and other expenses that you might expect in retirement, what monthly income do you need on a post-tax basis? And that's what you see there with goals. It says necessary, target, and aspirational, kind of in the middle left. You'll see that the target is $5,000 a month, and that's in current expenses. And that will be so that will then increase with inflation over time. And then at the household end date, which we typically put at 92 to 94, they would have $100,000 left over in today's dollars. That would be they would have left over. And so in case they outlive that life expectancy. And you'll see that kind of middle purple column is about $1 million. So if you were to discount all of that stuff to today's dollars and based off of standard in investment, or I should say standard rate of returns on investments, maybe slightly more conservative, you would need basically $1 million in today's dollars to hit that target of $5,000 per month at retirement for this individual, for this couple, and then also have $100,000 left over. But you'll see that their expected benefits, if they both would get Social Security, their Social Security estimates, and that would be reduced by 25% for taxes and Medicare Part B premiums, and potentially Part D premiums as well. That expected benefits, that's this big chunk right here. And then also the future savings. So that would be if they would max out traditional IRA accounts. And that's that orange bit there. If you add those up, you will see that they do not reach their target. They actually don't even reach a necessary amount. So extra savings or in some way monetizing their business sale is going to be needed. So we ran additional analysis. If they were to save, in this case, $2,500 per month. So that's $30,000 per year. So that's essentially maxing out a 401k with the catch-up contribution for one person who is over the age of 50. You'll see that if they do that and if they monetize their business, so that means business sale in some way, that's their current really strong asset. That's this new light blue column here. You see that if we add up all the value of their Social Security, their future savings, and selling their business, they do surpass their target. So one of the keys to look at here is that they do need to in some way sell their business and monetize in order to really make this retirement plan work. They could also save a lot more on their own, but it might be impractical in this situation. So next we said, all right, well, we clearly need to be saving in something. And for them, the cash balance pension plan was not practical right now, but the SEP IRA and the 401k were. And so we needed to compare which of these two were the best for them. And without getting into too many of the details, you can read through these on your own if you are particularly interested. But we made the determination that the 401k was less expensive for them in term when they took into account the different matching contributions that they would have to give to their employees while also funding their retirement goals. And ultimately, they're going to need to save a lot more than what the SEP IRA would allow them to contribute. And so the 401k is the better option and the overall less expensive option in terms of their ongoing costs and their safe harbor matching for their employees. They also had questions about money management and how they can move forward. And so, this particular client, we looked at paying off this business debt that they needed to earn back in order to start taking a real. They would take K1 distributions, but they wouldn't see the money; they'd just be taxed on it. But they needed to earn back some. They also need a personal emergency fund that they actually hit while we were making the plan. Their business has been quite successful, and that was great news to hear. And then also establish a stability fund. So they have on seasons and off seasons, and so the off season is generally speaking over the winter, and so they needed some money to carry them through. So they need a stability fund. And so we recommended that and made a rough goal. Unfortunately, by the end of this calendar year, it's unlikely they would hit that. And so we have a more easier stepping stone goal to hit by the end of this calendar year. And then these particular goals would be ideally hit by the end of 2024. Also, we really wanted to talk about their how to grow their business and prepare it for sale. And so we looked at, okay, well, how can we grow their business? So moving their business out of their house, hiring more workers, outsourcing some of the manual labor type work, and then also understanding their taxes in more detail, and then also talking about how they might sell it and transition it. So installment sales, this is where you sell your business. You write on the dotted line that it is sold 100%, but you receive payments over time. Selling shares is when you actually sell physical shares or percentages of the company over time, so they retain ownership. An installment sale, you give away all ownership when you sign on the dotted line, but you again receive payments over time. And then gifting shares is one way to gift it, usually to family members, but you can do it in other ways too. And then the family members could take care of you and provide money on their own to help fund your retirement. So then we get into the summary recommendations. And what we're seeing here is that we looked at and said, okay, we need a will to delegate assets. We also said we need to save in a traditional retirement account, save taxes now. Taxes in retirement are going to be less for them, and the growth that you would see in a Roth IRA, they didn't have as much time to let that growth occur, so it made more sense to save taxes now and pay less taxes later. Also, we looked at their insurance. We love looking at insurance policies and making recommendations on those. So we recommended dropping the other than collision protection on their older car that was worth less than $1,000. And this ended up saving them. This would save them $100 a year. They wouldn't get very much benefit out of it because the insurance company would declare the car a total loss after it exceeded $1,000 in damage. And when their deductible is $500, they're really not paying all that much and it's not worth it for them to keep that. We also talked about life insurance, and in this particular case, this particular couple, we felt as though they needed to analyze, do they really need their life insurance? And we actually came to the conclusion during the discussion that they did, but it was worth talking about. They also have four priorities that they need to pay off some debt, they need to have a personal emergency fund, they needed to build a business stability fund, and then save for retirement. And these are all sort of competing, and so we actually have a plan to help them with that on the next slide here. So we're looking and we say, okay, by the end of 2023, the goal is that we've paid off those business debts. We don't have any more losses. The gains over the past 2 years have offset the losses. We can start really taking K1 distributions, getting a lot more income. Also, that they would have sort of an emergency fund / business stability fund saved somewhere, whether or not it's in their business or in their personal savings accounts, so that they can weather the off season and also weather any emergencies, and at least just this year to start contributing $15,000 to their traditional IRA. That's maxing that out for both of them, and then opening up a 401k that starts January 1st, and then they'll be able to really start funding that. And going to recommendation number 7, we said, okay, fully fund that emergency fund, have $50,000 in their stability fund, and then contribute $30,000 a year to their traditional 401k plan. By the end of 2024, if they can be at that stage, they're in great shape. Lastly, we recommended that they grow their business, because that is an important part of their retirement plan, to be able to sell that. And then also they want to be able to keep their business and personal expenses separate. And so we talk a little bit here about how to keep those separate, but actually with cars, when you have a car that's used for both personal and business expenses, it's actually, from an accounting standpoint, easier to put all those, to record miles driven for business, and then also to put all of their expenses for that car on their business credit card, because it makes it much easier to separate the business versus personal costs, because you apply the percentage of the business miles traveled to all of those costs, and you can compare that to that first bullet point there in 9, to their business miles travels time the IRS standard mileage rate. And so from a bookkeeping perspective, this is the way you want to do it. Some more recommendations. So we actually recommended giving all the W-2 income to one person. So they were splitting the W-2 income. And so as much as possible, we want to shift that to one of the owners, because there's a spousal benefit where when you, if let's say one spouse has a Social Security benefit of $3,000 a month, and then the second spouse has a Social Security benefit of, say, $1,600 a month, while living, spouse number 2 has access to either 50% of spouse 1, that higher amount, or their own. And in this case, spouse 2 should take the $1,600 their own. However, if spouse 1 were to pass away, spouse 2 basically gets the higher of their own, which is $1,600, or 100% of spouse number 1's. And so that would be $3,000. And so it makes sense from a Social Security optimization standpoint to try to get all of your Social Security sort of onto one person as much as possible. So we recommended trying to max out one person's income and minimize the other person's income. Now, recommendation number 11 sort of plays in with this, where actually we want to, generally speaking, when you have an S corporation, you actually want to take as many wages as K1 distributions as possible. Now, the thing is your W-2 wages need to be reasonable for the area in which you live and the services that you provide. And when you do that, the rest comes as K1s. You actually save on self-employment taxes, because K1 distributions from an S corporation, you don't pay self-employment taxes. So that saves you roughly 15.3%. It's a little bit less than that when you factor in deducting half of that on your income tax return before you apply that 15.3%, but it's roughly 15.3%, a little bit less, but saves you on taxes. And lastly, There are health insurance options that are available and leading up to age 65 when you can start taking Medicare. So we analyze that here. And there are different ways. There's private health insurance, there's the federal marketplace, there's getting a part time job that provides that. So, for example, school bus drivers. But also, there are Christian health share programs. These are not insurance. We need to be very clear. They are not legally obligated to pay. And there are certain values that are come along with that. So there are certain things that are not health shared as a result of them, but they can be good cost saving opportunities for whose values align with them and provide not insurance, but a way of reducing costs. And we would love to talk more about that for people who are interested in that. Last recommendations, there's a small student loan that the parents have. And so we recommended paying that off, assuming that the Supreme Court does not, or excuse me, rejects Biden's executive order to forgive student loans. Uh, 14 here, working longer to improve outcome. We see this all the time. We run retirement snapshots, and really working longer always improves people's outcomes from a financial standpoint. You have less total retirement expenses because you don't have as many retirement years because you're working longer. But at the same time, Social Security really maxes out at age 70. So if you're still working at age 70, you need to start taking Social Security if you haven't already, because if you get to age 71, you're not going to get any extra benefit under current law. So even though we ran our retirement snapshot at full retirement age, it works better. You can always work longer, and that it does improve your outcome from a financial planning standpoint. Lastly, 15, this particular family does considerable giving as a percentage of their income. And so a great thing to do, and when you're giving to qualified charities, is out of traditional retirement accounts, when you reach age 70 and a half, using qualified charitable distributions, you basically don't pay any taxes. So it's sort of the golden zone of saving, where you save into a traditional retirement account, you don't pay any taxes when you save there. It grows until you reach retirement. Excuse me. And then if you give that money away directly from the IRA, you don't distribute it to yourself and then pay, you give it directly to a charity from the IRA, you end up not paying taxes on it there as well. So you never end up paying taxes on that money. And this is just something that we offer is 16, is letting a financial planner walk alongside your business. We love walking alongside our clients and meeting and through our financial planning membership model. All right. And then plug here for End Poverty. End Poverty is a great organization working primarily in Kenya at the moment, and they provide business financing, coaching, and community improvement, primarily to develop micro businesses into small, medium-sized businesses, as we don't see that as much in developing countries. And it's a great organization. We love advertising it as part of our financial plans, and we also do give directly to support them. All right. Hope that was helpful. If you have questions, give us a call. This is just one deep dive into one particular small business owner's information, but we would love to dive into your situation and learn more about how we can help and support you in developing a financial plan for you. Have a great day, and hope you're doing well. Thanks. Bye-bye now.